Well, many investors will probably tell you that they're glad 2011 is in the history books, despite some positive economic signs. Debt concerns here at home and in Europe, high unemployment, a feeble housing market, those are just all a major drain on any hopes of significant growth. Well, here with a look back and ahead is Catherine Avery of Catherine Avery Investment Management in New Canaan. Always good to have you on the program.
Thank you, Becky.
And we're going to direct our conversation largely toward equities today because that is your area of expertise. But before we get to that, overall, your assessment of 2011, where we've come this past year?
Volatility. I think that one word sums everything up. It's been a roller coaster ride that's careened like we've never seen before. We started out the year on a great footing. Corporate profits were coming in very nicely. And then in the middle of the summer, Europe started raising its ugly head. Concerns over there of a recession, the euro possibly even falling apart, and we took that to heart here in the U.S.
It really hijacked our markets for the most part.
It definitely hijacked our markets, and it also scared a lot of individual investors away from the markets. We've seen so many 100-point day moves in the market that people weren't sure, should I be in it, should I be out of it?
And it shook a lot of people out.
It did. It did shake a lot of people out. As a matter of fact, for this year, we're still negative on redemptions for mutual funds on equities.
Yeah, so people really are intimidated by what's going on. Here's the question, not much has changed as we move into 2012. We have ongoing debt and deficit discussions in Washington, ongoing debt and deficit discussions in Europe, talk of slowdown in China. So what do you see for 2012?
More of the same of that we had this year, more uncertainty, and that uncertainty means lower interest rates, probably still lower commodity prices, and interest rates that will be subdued. The 10-year Treasury is trading at 1.97%. That's the current yield. Money market funds have 0 to slightly positive interest rates. People don't know what to do with their money.
I think not only don't know what to do with their money, but are really concerned not only about growing their money, but just maintaining their money and not going into the negative.
Right. So
let's talk a little bit about what you're advising your clients.
We're advising our clients to keep some portion of their money in cash.
Are you?
Anywhere from 1 year to 2 years of annual expenses to be on the safe side. Anything outside of that, money that they need for 5 years and beyond, we're looking at high quality dividend paying stocks for our clients.
All right, when you talk about dividend paying stocks, high quality is key.
Very key.
How does an individual investor assess this? Because to have the dividend, you have to have the cash flow.
Right.
To have the cash flow, you can't have too much debt.
Right.
Otherwise, that cash goes to financing that debt. So, I mean, what should an individual investor look for when they're looking for these companies to put their money into?
Well, one of the best ways to do it is to go to your financial advisor and ask them for a list of these companies that meet those criteria.
Okay. Now, is there any way you can do it on your own? Let's say, for example...
Well, you can. There's the company's financials are all online.
Yeah.
And you can go online and you can take a look at how much debt they have and how much cash flow they're generating for the company. Also take a look at companies who have had a history of increasing their dividend over time. So for example, in our newsletter that we put out in the beginning of December, we focused on what we call dividend champs. And we looked at 3 companies that had increased their dividend more than 10% in the fourth quarter.
Is there a point though where they're increasing their dividend and that you may sense that there's a problem? Are there any red flags that you could spot that would say, okay, they're raising their dividend, but there might be some issues here?
Right. It's the cash flow.
Okay.
Again, it's that cash flow that's really key. And you have to keep an eye on that, because if we go into next year and we start to see that earnings are slowing down, obviously if earnings are slowing down, your cash flow growth can also be compromised. So we stay on top of companies by listening to the conference calls, doing our research, and looking to see that that cash flow is going to stay in place. How are they going to spend that cash flow? Are they going to be doing stock buybacks? Are they going to be building more plants? Are they going to be doing acquisitions? So it's an ongoing monitoring of these companies. It's not a buy it and leave it alone type of situation.
How often should you reassess your portfolio or where you've got your money?
I think for an individual, probably twice a year.
Okay, so the beginning of the new year, do you think that's a good time?
The beginning of the new year is always a great time to reassess, and especially for many people who were petrified by the markets last year and may have too much money in cash. You know, you have to remember, you don't want to be too conservative because, as we said before, money markets are paying you zero.
Yeah.
So you're at a great inflation risk here.
I see. As prices rise,
right. And
you're not earning anything.
Right. And if you're in your mid-50s, thinking about retiring someplace down the road, you want to maximize the amount of money that you can get on these assets.
All right, Catherine, Avery, always good having you on the program.
Thank you.
Happy New Year to you.
You too.
All right, we'll be back with more 12 on the Money after the break. Thank you. Always good having you.